Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra. It's a bit of a choppy Tuesday morning to begin trade. We started with the Nifty above 25,000. Then we dipped into the red, almost giving up nearly 100 points from the top. But after that, from 10:15 to 11, we've staged a bit of a recovery. Right now, it's mild green on the Nifty and the Sensex. Mid-caps, though, are holding strong. So it's a 1% gain on the mid-cap index and a good advanced decline ratio. 1,800 stocks advancing for about 550 stocks in the red. Hi.
Hey, Reema. And it was this particular index which wasn't doing so well yesterday. But yes, as you pointed out, there has been a swift recovery from the lows. We'll have to see whether we actually build onto that or we see some stability at these levels. Remember, GIFT Nifty was suggesting a start in the green to the tune of around 30 to 40 points. Mid-caps doing well. Some of these sectoral gainers include the likes of Pharma. We'll discuss that in greater detail. The Biosecure Act has been passed in the US. The small cap index too is up around 1% today. So it is giving that company to the mid-cap index. We have the IT space which is doing well. We'll discuss that in greater detail as well. Realty CPSE, which was under pressure yesterday, has made a comeback. Has made a comeback today as well. But definitely we have to talk about the IT space. Reema, there have been a lot of notes off late, right? And today there is a fresh one from Motilal Oswal, specific stocks as well. What does it say?
Well, so starters, they begin that the IT sector could be at the cusp of a recovery. They've gone through a very long period when discretionary spending was cut back. But now they believe that the worst is over and discretionary spending should come back. So their top picks in the sector are HCL Tech, LTI Mindtree, Persistent, Coforge. They have upgraded to a buy with a target price at 8,100. Their earlier target price was 6,100. They do not have a sell call on any of the IT companies. So on some of the others, like TCS, Infi, LTTS signed, they have a buy call. And they've got a few neutral calls as well, like a Wipro, Tech Mahindra, etc. Now, they've done a lot of analysis. It's a thematic report, a deep dive into, the factors which will drive the recovery, etc. And their key takeaway is that healthcare, manufacturing, and BFSI. These are the three verticals that could lead the recovery. Now, there are many angles to decide, how one should judge the recovery. One, of course, is, health of the clients. Second is the impact of generative AI. Third is the rise of captive centers in India. If, we have more GCCs, as they call it, global captive centers, they could take away work from IT service providers. So they've analyzed all these parameters, and their takeaway is that these three sectors will do well. Now, why healthcare? Because the threat of insourcing by GCCs is less. Why BFSI? Why will it do well? Because it will do well from rate cuts. And thirdly, those are the three sectors, and manufacturing generally has done well globally. Now, HCL Tech benefits because it has higher exposure to healthcare. LTI Mindtree is well positioned to capture generative AI spending, and Persistent Systems has high exposure to healthcare and BFSI. So keep in mind the kind of valuations, premium valuations it's trading at. And for Coforge, they've raised the valuation multiple to 38 times versus 30 times.
And 8,100 rupees is the target
8,100
there for Coforge. Okay. Coforge has been in focus. Few other brokerage
It's been a bit of an
late.
underperformer also. So year to date, Coforge is up 7-8%, while the Nifty IT index is up 19%.
No wonder the upgrades are coming up.
Yeah, so some upgrades are coming in because they had made that acquisition of Signity.
Yes.
So the street was a little skeptical about that acquisition. But now, Motilal Oswal says, they will be able to extract synergies, and it could be a good long-term asset for the company.
Okay, all right. So Nifty IT, the IT index generally in focus today. Thank you, Reema, for that. In fact, let's take this conversation forward. Josh Thomas from Quantum AMC is joining us now to discuss market fundamentals and a lot more. George, good morning. Thank you so much for joining in. First up, I have to ask you on the IT space. The index is doing well. There are positive notes coming in here. Do you think the worst is over in terms of the challenges that this sector faced earlier? And what is your pick? Do you like the large cap IT, or is it the mid cap space that you like more?
Yes, thanks, Sonal, for having me on the show. See, when you look at the last few quarters of IT results, the deal wins have been fairly strong, which means from a customer point of view, from a client side, there is an intention to spend. It is just that the environment was not very conducive, and therefore, most of them have kept the discretionary part of their projects on a different side. But generally, what typically happens is when the tech spend is muted for some time, that in itself creates a requirement for upgrading the technologies and things like that. And our sense is, that could happen sometime in the next year, so in the next few quarters. So one, there is a decent amount of projects which have been deferred, and that could kickstart. And the second thing is, if at all there is a lot of things, a lot of projects coming up on the Gen AI side and things. So the Indian players would get a lot of integration demands and stuff like that.
Do you have any IT stocks that you're betting on?
So we have about little more than 15% weight in the IT sector. A lot of that is towards the large cap IT names.
So a neutral call on IT. It's not an overweight with a 15% holding.
But relatively, our cash levels have been high. So on a relative basis, if you look at it, our exposure to the sector is slightly on a higher side.
What is your cash holding right now, George?
So our cash is around 15%, given the recent run-up and many of the stocks crossing our fair value estimates. So we have been having quite a bit of trims, majorly in the consumer discretionary space.
George, I wanted to ask you about the energy space. There have been a slew of notes. We have seen crude oil prices going below that $75 per barrel mark. There's been that big merger in the Gujarat-based gas companies as well. Is there anything that you like from the oil and gas space in terms of valuations? Yes, they are still reasonable, but some of these stocks have run up a lot.
See, we hold a couple of utility companies in the portfolio. And if you look at it, even if we were to normalize the earnings, our sense is, few of them are trading around fair valuation. But given how the stocks have performed in the recent past, and then considering that, many of these earnings profile is quite volatile in nature. So some of the gas utility companies, our sense is on a relative basis compared to market, it might might outperform the markets. But some of the oil producing companies might be affected as the crude prices comes down, because many of them had a certain threshold realization spec to $75 of crude, and as crude recedes those levels, we might see some of their earnings could be impacted.
So you are saying that gas utilities tend to benefit more in the current macros versus any of these oil companies, including the downstream companies?
Yeah, the utility companies, their earnings profile would be a lot more stable, is our sense. And we have been holding a couple of them in that sense.
Since you have a high cash weightage right now, what is it that you're expecting when it comes to the market? Is it just a period of consolidation? Are you expecting a bit of a correction, a deeper correction when you will look to deploy the cash in your books? What is your expectation for the next 6 months?
See, we typically tend to take a longer term view. If I look at the next 2-year perspective, our sense is given the levels where valuations are, the return expectations should be fairly muted. So we would look for a reasonable correction, maybe 10-15% to probably deploy most of our cash. But having said that, we are bottom up investors, and if at all any stock hits our buy limits as individual names correct, we would be happy to add. But at this level, our sense is overall market upside is quite limited, considering a lot of the future earnings is already priced in the current levels.
I know you wouldn't be able to speak about specific names, but you did say that you have the bottom-up approach, and there are some stocks which could hit the limit at which you could enter. Is there any sector, is there any space that you think is closer to reasonable valuations or is getting to a point where you can enter?
See, the obvious value pick at this point is private sector banks. Recently, we have reallocated some of our capital towards some of the leading private sector banks. And the reason being, the credit environment, our sense is would be kind of muted, at least in the medium term. And as and when the system liquidity has already started showing some signs of improvement, and as and when that improves, our sense is growth in some of these names could pick up, and that could reflect in the overall space moving upward. So apart from private sector banks, one other sector which we feel could benefit in the medium term is insurance space, where valuations have been fairly high for a very long time. And in the last few years, those have come to reasonable levels, and we have been able to add a couple of more names. So apart from these two sectors, our sense is IT could be one sector where earnings could surprise the consensus estimates. And to that extent, we might see some pockets of opportunities there. But the valuations there are not anywhere close to cheap levels. But there could be some bit of fill-up coming up from the earnings side.
So if we do get a 10-15% correction in which sector would you look to buy it? Because off late what's happening is that at the index level, we aren't seeing corrections. But individual sectors are going through their own, volatility, a bit of a decline of 10-15%. So that churn is taking place. So now if we get a 10-15% correction, in which sector will you look to deploy?
See, like I said, we don't target any sectors as such, but our sense is if you look at from a cycle perspective, banks remain favorable. IT might see a reasonably stable earnings profile in the medium term. And then again, the other sector where the cycle is kind of favorable is pharma, but even there, the valuations are not on a favorable side. So there is no sector as such other than the ones which I mentioned where we are kind of sensing, the valuations are very close to bottom or where we feel, we can immediately deploy. There are few select names in few sectors, but there is no sectoral call as such, which we can point out at this point.
Okay. All right. George, it was a pleasure speaking with you. Thank you so much for joining in. So not many opportunities. There are pockets which you could be looking at, but markets are not providing those comfort levels where one can go ahead and invest into fresh names. That's the word coming in from Quantum AMC, but we'll slip into a break. When we come back, we'll discuss what's buzzing in the commodities space, as always, with Manisha Gupta. Welcome back. You're still tuned in to Trading Hour. Well, the markets, they continue to be stable at these levels, but a lot happening in the commodity space as well. So let's shift focus to that. Manisha Gupta is joining in now, and today we are focusing on crude, Manisha.
Oh, well, yes, we are. Last week was a 10% decline for the crude oil prices. And when you look at the third quarter itself, the crude oil prices have turned 15% into negative. Overnight, we did see some gains coming in. And this is after following on what really is happening in the Gulf of Mexico. The Hurricane Atlantic season is upon us. And there are concerns that 120,000 barrels per day could be impacted because of the Hurricane Chansey, which can convert into a second category hurricane, make a landfall on Wednesday. And ahead of that, various companies within that area have said that they have either evacuated, partially shut down various plants there, and that is where we saw the premium coming in from. Having said that, it hasn't sustained, and that clearly is what the crude oil prices seem to be doing right now, even as OPEC and allies have said that they are postponing their output production increases by 2 months. We didn't see that impact come in on the crude oil prices, and lower lows is what we've seen come in for this commodity here. The markets also have seen various statements come in from banks and brokerages talking about lower crude oil prices now. Bank of America and Citi are talking about 75 and a possibility of 60 as well in the next year. A latest report from Trafigura also has seen a revision in sense of forecast. They're talking about $60 to $70 of crude oil prices there. Morgan Stanley has come out with the latest report saying that the global oil markets will see 1 million barrels per day of a surplus in 2025. They also have brought down their fourth quarter Brent expectation to 75 and WTI at 70 for the next year. Now, Street, of course, will watch out for the U.S. inflation data that comes in on Wednesday and Thursday, and further direction would come in for that. But at this point in time, continuing to trade negative for crude.
Thank you very much for that. We will slip into a very short break. We'll come back and discuss technicals with Videsh Thakkar. Stay tuned. Welcome back. The Nifty is once again trying to get back towards 2,500, and now the consumption names are back in focus. ITC, Titan, Nestle. These are stocks where there have been some gains in the last 30 minutes. Videsh is now back with us for a quick technical check on the markets. Videsh, are you heartened by the intraday pullback that we've had in the last 1 hour? And what would the top calls be?
Yeah. See, the idea is that we were, kind of struggling a couple of days back, and then yesterday we had some kind of a pullback, and we haven't tried to break below 24,800 today. So to me, I think that's a positive sign. The setup has been slightly negative because the hourly and the 2 hourly charts are still showing, declining indicator setup. But if the market can hold on to support levels and, the indicators can cool off, then that will pave the way for next leg of up move. So in that sense, I think as long as we are not breaking 24,800 on a closing basis, I'm very happy. And on the upside in the short term, I expect 25,150 and then 25,050 and then 25,150 will act as supply pivots. But we might see a choppy range for the next few days, and that will be a good outcome to me. And once this range breaks on the upside, then I think we'll see continuation. So broadly, 24,800 remains the key level for me to watch.
Okay, so that would be the next important level. Mitesh, what would the stocks be in focus, your trading bets, or something that would contribute to this up move going forward?
So I have one buy and one sell call right now. Indian Hotels, after a good consolidation, is breaking out today. That's a buy. Keep a stop below levels of 678. Look for 720 as the target. And HDFC Life, after a very good rally, showing first signs of profit booking and correction. So on a mild pullback, say around 714, 715, try to sell with a stop at 728 and look for a target of roughly around 685 to about 680.
What about, ITC, Titan, Nestle? The FMCG index has given a positive return now, I think for the third consecutive month, and seldom has that happened before.
So, Nestle to that extent, I think has been an underperformer, and I've been focusing on Dabur, HUL and Marico over there. ITC keeps doing well, but from a trading point of view, wait for the stock to get past 515 and then we can see a trading rally to about 540, 545 levels. And that apart, as I said, I think, my preferred picks would be Marico, Dabur and HUL.
All right. Thank you, Mitesh, for joining in. So those are some technical bets by Mitesh Thakkar. For the markets, yes, there's been a recovery and mid-caps, they continue to fire 600 points higher on the mid-cap index as we speak. Let's slip into a short break. Up next, we'll get you excerpts from the conversation we had with Partho Banerjee, the Senior Executive Officer of Marketing and Sales at Maruti Suzuki on the sidelines of the SIAM Annual Convention.
Welcome back. Let's get you a special corporate interview, and that's with Maruti Suzuki. Now, they're saying that they expect hybrids to contribute 25% of the industry car sales and EVs to contribute 15 to 17% to the car sales by 2030. This is the word coming in from Partho Banerjee, Senior Executive Officer of Marketing and Sales at Maruti Suzuki. He was chatting with my colleague Parikshit Luthra at the SIAM Annual Convention. He also said that Maruti will showcase its electric car at the Auto Expo. Listen in.
Just to give a perspective on the festival season, this year the Onam is in the month of September, starts on 15th of September. Last year it was in the August end actually. But if I try to compare the numbers of last year August versus this year numbers for Maruti, last month in Kerala we saw a growth in the booking to the tune of 11%. So which is a very positive sign for us. And just to give a perspective that on this Saturday we had that Ganesh Chaturthi. So the markets where generally this festival is very popular, there we saw a 10% growth in the deliveries. So if you ask me, Parikshit, I feel that we are seeing the green shoots coming and we are hopeful and very optimistic that the festival seasons we are going to see a good sales.
So if it was around 168,000 vehicles in total for Maruti in the month of August, how much could it be in September? Would this calibration continue for the next few months?
We have to understand one thing, that this year the festival season, the Navratra starts just in the beginning of the month, October. 3rd October is the first day of the Navratra. Most of the customers prefer to take the delivery of the vehicle on the first day of the Navratras. 2nd October happens to be a government holiday. So the dealer will be requiring the vehicles to get it registered, then only they can deliver it to the customers. So we are very clear on that. Based on the market demand, whatever vehicles are required, we are going to serve it to our channel partners.
But this, we've seen high level of discounting. So is this discounting now going to continue, or is it just an action of about 1 or 2 months now?
Parikshit, these are market forces which decide what is there depending on the market conditions and other things. But we feel, and through your channel, I would like to give this message to our customers. This is the right time. If someone is looking for buying the car, please go ahead and close the deal.
Yeah, because the discounts are best ever at the moment.
Right.
My final set of questions, sir. We have seen this debate across the world on hybrids versus EVs. What has been the offtake of the hybrid segment in your portfolio? We already know that you've got a strong CNG sales portfolio, but when it comes to hybrid sales, what has been the offtake, especially in states which have recently activated their hybrid policies like Uttar Pradesh and Haryana?
Parikshit, first of all, I think that this is something I would like to, again through your channel, would like to convey to all our media partners also. It is not like that EV versus hybrid or diesel versus CNG, not at all. We being the market leader, we need to be technologically agnostic and we need to serve all set of customers. So there is nothing like that EV versus this, so which debate is going on. For each technology, there is a set of customers who are going for it. Now, to be very honest, if you ask me strong hybrid, one of the biggest thing is this, the benefit is this, it's a combination of both. And it gives you very good mileage. And at the same time, you don't have the anxiety of the range, which is a bigger issue today. But we are also coming in the EV. In the auto, this Bharat Mobility Show 2025, we are going to showcase our first EV vehicle. So it is nothing like that Maruti is not into the EV. But at the same time, you need to understand that a set of customers, we should give that option to the customer. Why we should decide that customer should only go for that? Being the market leader, give all the technology offering to the customer and let the customer decide. Right. That's what we are trying to do being the market leader. Now, coming to the hybrid, yes, the share of business of hybrid is going up as compared to the EV. You all know that hybrids are now, customers are preferring it. And I think thanks to some of the state governments for coming up and giving that option to the customer, that let the customer decide which technology they would like to prefer to.
Right. What would be your percentage of hybrid sales?
Ours is around 16% of the models in which we are offering the hybrid.
Okay. So 16% of particular product lines.
Products, yeah.
And overall sales?
No, because we are presently offering the strong hybrid only in 2 models. That is the Grand Vitara and the Invicto. So of that total sales, it is 16%.
All right. And how much do you expect the hybrid sales to go up in the next, say, 5 years? The reason why I'm asking is that globally we've seen a demand for hybrids wherever subsidies have been sought for electric vehicles. BYD today has raised its annual forecast because of a surge in hybrid vehicles as well. How does that make you optimistic, and what kind of a portfolio percentage wise would we see between, say, ICE, CNG and hybrid by 2030 and EV?
You asked me first about the CNG. Today, every third vehicle which we are selling from the Maruti portfolio happens to be a CNG vehicle. Last month, close to 50,000 vehicles were CNG vehicles from our product portfolio. That is also one way to contribute in terms of reducing the carbon footprint actually. Now coming to the forecast, I can give you a forecast for 2030. We feel hybrids will be around 25%.
Of the passenger car industry or Maruti?
Passenger car industry. I'm giving an industry outlook. Electric vehicle around 15 to 17%, which we feel. That's the percentage we feel. So our take is a strong hybrid will be around 25%.
Okay, all right, that's the word coming in from Maruti, but it's time for a short break now. Rahul Gua from Crystal Ratings will join us next to discuss the latest trends from the sector of gold, the jewelry space, and what the duty cut has done to this space.
Welcome back. So jewelry companies are in focus. Even today, you've got names like a Titan, which are holding up in the green. Yesterday, we were chatting with the management of Senco, where they said they're also positively surprised by the kind of demand that we've seen in the early part of September. And not to forget, P.N. Gadgil's large 1,100 crore IPO in terms of an issue size, which is a combination of fresh issue of 850 and an offer for sale of 250 crore, also opens up. Not just that, you also had a CRISIL note where yesterday the company said that the revenues of the organized gold jewelry retailers will increase by 22 to 25% this year, a good 500 to 600 basis points more than the 17 to 19% that they were earlier anticipating. And this is following the sharp reduction in import duty announced in the budget. Rahul Guha, the director at CRISIL Ratings, is now joining in. Rahul, morning. Thank you for joining in. This is Reema here. Take us through what your analysis has thrown up. Why have you upgraded your assessment of growth for the gold retailers?
Hey, hi, Reema. Thanks for having me on the show. What we're trying to say is, for the first time, we are seeing volumetric growth to happen in this particular sector. Now, if I just take you back in time from the year 2019 to say 2024, the volumes were largely flattish. They were less than 600 metric tons at all point in time, almost at about 580 odd metric tons for a fairly long time. I'm keeping aside the COVID years because in COVID, they had fallen to somewhere as low as 400 metric tons in those 2 years. Now, for the first time, we are seeing that the volumetric growth here from 580 odd metric tons will cross 600 in the last 5-6 years. At about 610 is the projected number that we are looking at for the organized segment. And correspondingly, if I look at the prices, they have remained firm. On a YOY basis, we see that last year the average was somewhere around 60 to 63,000 odd per 10 grams. The price that we'll be quoting on an average for this year will be in the range of 73 to 74,000 rupees per 10 grams. Now, if I do the maths here, that somewhere translates into 22 to 25% industry growth in terms of revenues on a YOY basis for fiscal 25.
And this is after speaking to how many jewelers? Tell us a little bit more about the survey. And again, just break up that 22 to 25% revenue growth in terms of volumes and price increase.
Sure.
What will be the volume? Yeah.
Sure. So the overall industry, if I look at in terms of organized plus unorganized, that will be somewhere in the range of 8 to 9 trillion INR. And the organized would be somewhere in the range of 35 to 40% of this particular industry. CRISIL has a portfolio of about 58 companies in this organized space that contributes almost a third of the revenues of the organized industry. So that's the kind of database that I'm talking of, through which we have derived this particular analysis. On the volume front, as I said, we expect the number to move from about 580 metric tons to somewhere in the range of 600 to 610 metric tons. So somewhere 4 to 5% kind of a jump is what we are seeing YOY. And on the realization side, the average cost was somewhere in the range of 62 to 63,000 for the last fiscal. Against that, we anticipate about 18 to 19% kind of a average being on the higher side at about, say, 74, 75,000 rupees per 10 grams. So net, this will translate to 4 to 5% on the volume and 18 to 19% on the value, corresponding to somewhere around 22 to 25% consolidated for the overall industry revenues.
Okay. You know, Rahul, you are talking about 18 to 19% value growth. So that's a big pricing growth and something that we've seen from the day the duty cut was announced till now also. We are around 75,000, right? So are we expecting a further up move by the end of the year as well? And do you think by then we'll see some impact on demand? What are the conversations suggesting? And is it different for the unorganized space? Because that the organized space seems to be doing really well. What are the trends in the unorganized space?
Maybe I'll take the question on the demand side that you're talking of, or the pricing that we are looking at. So I think at a CRISIL level, basis our analysis, we understand that the price would stabilize in the 75,000 rupees range for the rest of the year. There will be an upside over the next fiscal where the prices could range between 76 to 80,000 odd rupees per 10 grams, 24 carat is what we are forecasting. That's on the pricing side. On the volume side, we will also have to understand one particular aspect, that in the H1 of this particular year, we had lesser number of auspicious days. So these were just about 17, 18 auspicious days, as against if I look at an average of H1 for the last 5-6 years, this number would have been somewhere in the range of 30-35. So it's almost half. The second half, we do have a significant number of auspicious days, plus the festive season kicks in along with the wedding season. So that's going to drive this 4-5% kind of a volumetric growth. As far as the unorganized segment is concerned, we need to understand that at some point in time, maybe 5-6 years ago, if I look at the unorganized was at almost 65-70% of the overall industry, and the organized was at about, say, 25-30%. Right now, what we understand is the organized will be somewhere close to 35-40%. And probably by the year 27-28, this ratio could be in the range of 50-50. 50% organized and 50% unorganized. So in a way, we can say that the organized are growing at the expense of the unorganized players across cities. So that's how it's been.
Okay, so organized are growing at the cost of unorganized players in the jewelry sector. Inventory losses, how does that pan out in this case? Because there have been some duty cuts and it impacts the inventory number as well.
So the inventory policy of most of the organized players is pretty well taken care of. They don't stock up too much of an inventory. So whatever I'm selling, I will typically procure the very next day. Now, what had happened during this particular duty cut, if I recollect, 24th of July is when this duty cut was announced. Suddenly, the prices, they crashed by almost 4,500-5,000 odd rupees per 10 grams. Now, that would have led to some bit of an inventory loss. But the fact that the ability of these players to pass on some of these to the end customer will somewhere curtail that inventory loss. It's not going to be a huge inventory loss. But yes, there's going to be 20-30 bips kind of a fall that will happen because of this sharp prices that came down so sharply over on the 24th of July. So that's how it's going to look like on the inventory loss side for the players.
So Rahul, when you spoke to all these 58 companies, what else did they tell you in terms of their expansion plans, in terms of whether there's 4-5% volume growth, which we've not seen for the last so many years? Volumes have been flat, as you said, for the last many years. Is this something which is sustainable? What else did your conversations cover apart from this year and, you know, the inventory picture?
So I think we have to also understand gold has continued to remain as a very steady asset class. And today, if I look at all the global trends or the global macros, there is some amount of market volatility that is prevailing. Plus, there is a lot of uncertainty that is around the geopolitical tensions that we are seeing. So from that aspect, gold definitely has come across as a very steady and a strong asset class. That also, in a way, if you look at the prices have moved from almost 31,000 rupees in 2018 to more than 74,000 in 2024. So you have to understand the prices have more than doubled in the last 5 to 6 years. But in spite of that, the volumes are now picking up over the last couple of years and expected to remain 4-5% on the upside over the next couple of years. So as an asset class, I think gold is doing really well. That's continuing to drive the demand. Coming to the capex, I think most of the players are pretty bullish on the market sentiments or the demand side scenario that we are seeing. On the crystal portfolio, if I have to specifically look at, we are talking of almost 12-15% kind of an asset base expansion, which will tantamount to somewhere around 180 to 200 stores for the crystal portfolio, which if I extrapolate for the industry, we can look at almost 600 to 700 stores being put up by the organized segment during this fiscal.
Okay. All right. Rahul, thank you so much for joining us with the analysis, a deep dive into what's happening with the jewelry sector and the duty cuts and the impact thereof on the organized and the unorganized space. Look forward to speaking to you yet again, once the festive season kicks in and we see more deeper demand trends coming in. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that. Welcome back. Well, there is no dearth of any action in the IPO market. In fact, jewelry retailer PN Gadgil's 1100 crore rupee IPO has opened for subscription today. Mangalam is joining us with all the details, the risk factors and the valuations as well. Mangalam.
Well, you said there's no dearth of action, right? This is the fourth IPO of this week itself, and we're just 2 days into the week. It's an 1100 crore IPO that opens today. It's a fresh issue of 850 crores, an OFS of 250 crores, and a price band at 456 to 480. At the upper end of the price band, the company is actually seeking a market cap a little over 6,500 odd crores itself. Before the IPO opened for subscription, the company's already raised about 330 crore from anchor investors at 480 rupees, and the kind of investors we have are a lot of these respected domestic mutual funds as well. What is it that the company does? It's an established jewelry brand in Maharashtra. Pune accounts for 65% of its sales itself. The second largest organized retail jewelry player in Maharashtra. And remember, for the overall industry, West accounts for 25% and Maharashtra itself is 46%. So if you're looking at a $70 billion jewelry industry, nearly 10 to 11 billion comes in from Maharashtra. The company is looking to raise these funds to set up 12 new stores and also prepay 300 crore of debt. On their books, as of last reported numbers, the debt was close to 396 crores. If you look at the total stores that they have currently, 36, that is much lower than all the other peers, including the likes of Titan, which is 490, Kalyan, 277. A more nearer competitor would be Thangamile, which is at 59 as well. But the company intends to open 60 stores or get to 60 stores by FY27. In FY24, they did revenues of close to 6,100 crores with margins at 4.4%, much lower than the peers, but they've guided for improvement in margins as well. And for all of this, they're seeking a valuation of 42 times FY24 price to earnings. And if you compare it to all the others, 1 year forward, they're trading at a premium. So the company, because of its lower margin and because of its regional, presence and a smaller size as well, is asking for a discount to the listed peers, as you can see on your screen itself. We spoke with the management this morning. They gave us key targets for FY27. They're targeting 10,000 crore revenue, double-digit margins, 15% share of revenue coming in from studded as against 10% right now. And they are from 36 right now, targeting to be at 60 stores by FY27 as well, with an aspirational target of 100 to 120 stores over the next 6 years. So those are a bunch of factors that we'll keep an eye out on. If this company goes ahead and does a net profit of close to 250 crores in 1 year forward and 300 crores 2 years forward, then it would be attractively priced as against peers right now.
Thank you. That's a sharp margin expansion that the company is guiding for double-digit margins by FY27 versus 4.4% last year. Thank you, Mangalam, for putting that IPO in perspective. With that, it's a wrap on Trading Hour. Stay tuned. Halftime Report is up next.